Welcome back, everybody, to VTS Options. So today I'm going to go over a very effective option strategy for what we call bottom fishing. This is when the underlying stock, ETF, or index has been going down recently, and you want to try to play for a potential bottom and reversal in the action. The problem, though, when buying something that's going down recently, sometimes this does lead to knife catching. The analogy is basically if you can imagine a falling knife and you reach out and grab it, you can cut your hand. The same analogy can apply to the markets. When things are going down recently and you go in there and you buy, well, things can just continue to go down further, and you end up cutting your hand, so to speak, knife catching. But options trading, as we know, does allow for much better risk management. We can go in and buy something with confidence expecting a market bottom, while at the same time still protecting against further downside. And a great way to do this is through the option spread called a short put vertical. So subscribe to the channel, hit the like button for me, and thanks for joining me today. So I'll get into a full trading example in just a few minutes here, but the short put vertical is opened in a single transaction by selling a short put option and then buying a further out of the money put option against it. And this is what that risk profile looks like. So if we take a simple example first, we have stock XYZ currently trading at $60. And in one transaction, we're going to sell a 60-50 put vertical spread for $5. So that's a short $60 put option, and then a long $50 further out of the money put option. And what this does is cap both the maximum gain and the maximum loss. To calculate the maximum loss, we take the difference in the strike gap, subtract the premium we collected for the trade, and then multiply by the options factor of 100 because each one option contract represents 100 shares of the underlying. So with strikes of 60 and 50, the strike gap is $10. We're collecting $5 for the trade, multiply by 100, and that makes the maximum loss no matter what happens to the underlying $500. And for the same reason, the maximum gain is capped as well. To calculate that, it's simply the premium that is brought in for opening the trade multiplied by 100. In this example, collecting $5 of premium, that makes the maximum gain $500 as well. So the reason we like verticals so much is they make risk management pretty easy. We already know ahead of time what we stand to make and lose, so the trade just becomes about timing the entries and exits, and then proper position sizing. The option Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. The three main ones we focus on are delta, theta, and vega, price, time, and volatility. Delta is the option sensitivity to price. Short put verticals are delta positive. They're bullish trades, and we do want the underlying to go up, which makes them delta positive. Theta is an option sensitivity to time. Short put verticals are theta positive, meaning we benefit from the passage of time. And lastly, vega is an option sensitivity to volatility. Short put verticals are vega negative. These trades benefit from decreases in volatility. So ideally, you don't want to initiate these when volatility is already at a low level. If you sell them when volatility is a little bit higher, the trade can benefit if it drops down a little bit during the life of the trade. But now let me go through a full trading example to illustrate these points even further. Okay, so here we are inside the Thinkorswim platform from TD Ameritrade. And I'm going to go over an example for how I might trade the short put vertical. Now there's actually many applications, it's quite a versatile trade. But I'd say for me, the two most common ways that I would use it, first of all, would be to play for something that's crashing significantly. Now we've got markets at all-time highs here, as you can see, this is the S&P 500. So it might be difficult to find something that's really crashing recently. But that is a good way to apply this trade. So anytime you see market bottoms like this, where things are going down, this is when you could start selling short put verticals anytime you're in these ranges, both on indexes and individual stocks. Of course, we can't predict when it's going to hit the bottom, but this trade is all about risk reward, and the further things are going down, the more likely it is to start bottoming and maybe recover a little bit. So that's the first way I would use this. The second way that I typically use this trade is an example that I'll go over today, and that'll be on the ticker TLT. This is 20-year US Treasuries. Now the basic concept of this and how I would apply a short vertical put spread is you might also be looking for something that's not necessarily beaten down in value, but as you can see here, perhaps forming some type of base. In the case of TLT, we can see that it's basically gone nowhere in the last several months, and this might be a good risk-reward profile that it's not actually going to break to the downside. Now remember, bond funds like TLT, the simple thing to remember is that they tend to go up when interest rates are going down. And then of course vice versa, when interest rates are going up, bond funds tend to go down. Now we have seen with Federal Reserve announcements recently, they have made it quite clear that they're at least going to hold rates steady, if not perhaps go for even more rate cuts. You can see these are all the rate decisions since December 2015 when they started normalizing. And mid-2019, there was a pretty significant policy change here where they actually did 3 straight rate cuts. Not that they didn't telegraph it, they certainly did. But it's just surprising. All we keep hearing is how strong the economy is, and yet the Fed is cutting rates. But long story short, as long as rates are holding steady or perhaps even going to go down further, something like the TLT probably will be able to hold steady if not make some further gains. So that's why this is my example today. So I'll go over to the Analyze tab. We've got all the monthly expirations here. And for this trade today, I'll just choose about a 1-month time horizon. This February contract expiring in 36 days, that's going to be about right. So the TLT is currently trading about 139.65. And so when I'm selling my short strike for this trade, I'm going to do something outside of the money. So in Thinkorswim, the puts are over here on the right. The one strike that's just outside the money is this 139. So I'm going to sell to open a vertical spread. And this is what the risk profile looks like. So you can see down here what's happening. We are selling the 139 put. That one is right here. And then in the same transaction, we are buying the 138 put further out of the money. So today's price is here. We're selling the 139 and buying the 138. And when you do this as a put vertical spread, it actually caps both the gains and the losses. This is why we like this trade. Risk management is much easier when you know ahead of time how much you can gain and lose. So this maximum loss down here, this is very easy to calculate. We just take the difference in strike price, so the difference between 139 and 138 is $1, and we subtract the 40-cent premium that we bring in for the trade. That would be 60 cents, and then each one option contract represents 100 shares of the underlying. So we can see the maximum loss, no matter what happens, is $60 per contract. Now the max gain is capped as well for the same reason. This is even easier to calculate. We actually just take the premium that we collect, the 40 cents, and multiply that by the same 100, and we get a maximum gain of $40 per contract. So it's a pretty balanced trade on the gain and loss side. Like I said, risk management is pretty easy, so a trader can actually just let these expire. You do have to pay attention around expiration, just to see if you're going to get assigned anything. You might want to close it early if that's going to be the case. But another thing that I often do is I focus on this pink line, which is the daily profit curve. You can see today's price is right about there. Of course, when we open the trade, it's going to be about 0 profit. But on a day-to-day basis, as it moves up and down, you can see that the profit will change day to day. It's bouncing around a little bit here on the example because it's moving around. But what this means is we can use this pink line to have stop losses and stop gains. I typically do about 50% of the premium. So on the stop gain side of things, if we collect 40 cents, when this premium goes down to about 20 cents, that might be time to close the trade. That would be $20 per contract. So I can actually just go out and find $20 right on this pink line and put the little hash line right there. And then on the loss side, again, find that $20 and then go ahead and put another hash line right about there. Close enough. And this is my trade. So I can actually watch when it's going to be in between these lines. The trade's still going to be left on. If it breaks to the high side, I'm going to stop gain. And if it breaks to the low side, I guess I would stop loss. But that's a very easy way to manage your trades day to day. You can just take a quick peek at it every now and then, and you can size it up really quickly to either stay in the trade or consider closing it if it's past these points. But now let me go through the Greeks really quick. The first one is delta. So here's today's price. You can see this is a positive number, which means it's a delta positive trade. We want the price to go up. And of course, we can see that here. Anything in this direction is going to be good for us. That's going to be the profit range. So short put verticals are bullish trades. Whatever we're trading, we want it to go up. The next Greek is theta. And here you can see it is a theta positive trade. Now it's not much, but this will add up every single day. So as each day passes, we're going to be collecting a little bit of money. And you can see that again in this picture. Right here at today's price, the reason being theta positive is an advantage is because even if the price doesn't move, let's just imagine it stays in this middle range here. Every single day, our profit is going to be ticking up because theta decay. And even if TLT went nowhere, we could eventually just hit our maximum profit, or at least hit the stop gain and close the trade out for a winner. So the positive theta here is a good thing. And the last Greek is vega. You can see here, vega negative. This means that the trade benefits from a decrease in volatility. This gets back to my original statement when I said there's actually 2 ways you can use this. Typically, when stocks are beaten down in these ranges here, that is when volatility is going to be elevated. So a trade like this that is vega negative, if you initiate it when volatility is elevated, then it does leave room for volatility to go down and actually make us some more money. Now right now volatility on TLT isn't overly high. So I will also mention that because this is a spread, we're buying and selling contracts that are fairly close together. While it is Vega negative, it's actually a little bit less important than some of the other option trades that we take. So we can still get away with trading these when volatility is in a middle range, like it is with TLT right now. But that's the trade. It's very simple. We are basically playing for something in this range, considering this a basing, sort of a support level, putting on a roughly 50-50 trade that we're not going to break to the downside. Like I said, on the one hand, the Fed is going to be a little bit nice here and they're telegraphing their rate policy stuff ahead of time, and also stocks at all-time highs. It is possible that within a short period of time, we might actually see a little bit of a pullback here, and TLT might benefit from that as well. No guarantee, of course, this market is extremely strong as you can see, but you'd think at some point it's going to happen. So that might tilt the odds slightly in our favor again. So to sum this trade up, these are delta positive trades, which means we do want the underlying to go up in value. They are bullish. That means these are very effective trades to initiate on something that's been going down recently, and you want to try to play for one of those reversals. Or like I showed you in the example, you can also set those short strikes just outside a major support level, playing for the fact that it probably won't break below that. Short put verticals are theta positive, which means time is on our side with this trade. Even if the stock price just hangs out in a range and doesn't really move too much, we can still collect that daily theta and actually reach the full profit. This is a higher probability trade. And lastly, these are Vega negative trades, which means they benefit from decreases in volatility. That's why it's always best to initiate these when volatility is already a little bit elevated, allowing for a little bit of room for it to fall. So if you like this trade and you want to see other live examples, as well as many other trade types as well, head on over to VTS Options, claim your free trial, and join the VTS community when you're ready. You're always welcome. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.